The numbers are growing, so let's begin our session. Welcome to the March Climate Bonds Luncheon session. This month we'll be covering a topic that is both hugely important and highly relevant to current priorities around financing the fight against climate change, oil and gas transition plans, and the methane blind spot. Climate change brings significant downside risks to both economies and societies, and everyone needs to prepare for that. The global economy is now orienting itself around the transition to net zero. Both developed and emerging economies are making commitments, creating plans, and implementing policies to support and enable transition at scale. This is creating new opportunities, and it sends a clear signal. The agenda moving forward is transition, and planning for transition is planning to succeed. I'm Gabriela Constantin, Transition Project Manager at Climate Bonds Initiative, and I'm happy to moderate today's session. For those who may be new to us, Climate Bonds is an international organization working to mobilize global capital for climate action. We promote investment in projects and assets that are essential for a rapid transition to a low carbon and climate resilient economy. A few words about today's session. We will be looking at oil and gas transition plans and the methane blind spot. Using the oil and gas sector as a case study, the session will explore the purpose and structure of transition plans, including how they can support investment decision-making, both from a financial risk and a climate impact perspective. We'll also look closely at the methane challenge in this sector. We'll discuss the limitations in current corporate methane targets and measurement strategies, and highlight key questions investors should be asking to evaluate ambition and risk exposure. The presentation will also touch on the implications of methane emissions for gas-based CCUS projects such as blue hydrogen. We'll have two presentations from our guest speakers spanning about 30 minutes, followed by a Q&A session. Please feel free to post your questions in the chat through the session or after the presentations. We are joined today by Olivia Bison and Richard Collett-White from Carbon Tracker. And now it's my pleasure to introduce our first speaker. Olivia, you joined Carbon Tracker's oil, gas, and mining team as an associate analyst in 2023. Prior to that, you managed a project on climate-related financial risk at the University of Oxford. You've also advised private equity, growth equity, and private credit investors as an ESG management consultant, completing over 200 ESG due diligence reviews. Thank you so much for joining us today. Over to you.
Appreciate the introduction. So I think we can pull up the slide deck. And as Gabriela previewed, I'll be presenting today on oil and gas transition plans, and then followed by my colleague Rich Collett-White, who will be presenting on methane. So just to give you a bit of an overview, my presentation is touching on some of the highlights of our oil and gas transition plan user guide, which my colleague Mike Coffin published last summer. And then we'll be pivoting into the methane conversation. So next slide, please. Just a brief overview of what Carbon Tracker is, what we do for those who aren't familiar. We're a non-for-profit financial think tank with a vision of a fully decarbonized global economy by 2050. Next slide, please. And our research really assesses climate-related financial risk and opportunity across the board with an aim to support the energy transition by mobilizing financial markets. So this spans oil and gas, which we're highlighting today, but also power and utilities, automotives, other heavy emitters, both from a corporate research perspective, but also regulation, auditing, economic risk modeling, et cetera. Next slide, please. So corporate transition plans have been getting a lot of attention, and rightly so. You know, lots of corporates are publishing plans, and they take all different forms. So ranging from energy transition strategies to sustainability progress reports to so-called climate solutions. But a lot of these plans are conflating different things. So they might be conflating emissions reductions with mitigating financial risk with investment in new technologies. And so it can be really difficult for investors to understand how to navigate these different types of plans. Similarly, there are lots of different frameworks for assessing plans. You know, some of them focus on operational emissions, others focus on how much data is disclosed, but not necessarily sector-specific analysis. And, you know, this isn't necessarily the most decision useful for investors. And so how do you navigate this landscape? That's what our report really aims to do. And I'll be touching on some of the main points, but I encourage you to download the full report from our website if you want to get into more of the specifics or have additional questions that aren't answered in today's session. So first, you really want to be clear on what you're aiming to assess through the transition plans. And really, corporate transition plans have a kind of a twofold purpose. The first being looking at the climate impact of the company's activities from an emissions perspective. And the second being looking at the climate-related financial risks and opportunities facing the company. And these are kind of two distinct points. Next slide, please. And so in response to those two distinct dimensions, we really view two different types of plans as being relevant and relevant for different audiences and investors. So on the climate impact reduction plan, this would be really relevant for investors and other financial institutions with emissions reduction goals. So those, you know, that face fund labeling requirements, those with their own investors who are seeking for emissions to be reduced, and those, you know, for example, pensions that have a fiduciary duty to take a very long-term outlook in their investment decisions. And this could look at, you know, climate alignment from a Paris Agreement perspective. And then on the climate risk response side, this would be relevant for all investors because, of course, all investors have to consider a wide array of risks in their investment decision making. And there are really three kind of main buckets of risk for the TCFD. So there's physical risk. So how are physical climate damages going to affect companies' assets? There's transition risk as it relates to policy. So for example, thinking about methane regulations, which Rich will touch on later. And then third is transition risk related to technology and consumer preferences. So for example, is your product being threatened by an alternative? And this third bucket is quite relevant to the oil and gas sector, as we'll highlight today. Next slide, please. And so as an investor, you need to be clear on what you're trying to assess. So for many sectors, these two types of transition plans can be quite similar because you know, a decarbonization strategy can be taken to both mitigate climate-related transition risk as well as reduce the climate impact of the company. But the oil and gas sector is very different from others. So the energy transition affects the demand for the fundamental product. So it's not like you can simply produce a widget with fewer scope 1 and 2 emissions and, you know, select suppliers that are a lower carbon upstream to reduce your scope 3. Really, this is the actual combustion of the product that is creating the emissions. And so it's really an existential threat to fossil fuel suppliers. And kind of another unique point for this sector is that certain actions that may reduce the climate impact may not necessarily mitigate your transition risk and vice versa. So it's not just, you know, the same strategy can be taken to both mitigate risk and reduce climate impact. Next slide, please. about the climate impact assessment, what should investors be focusing on? And really the bottom line is you need to be looking at the pace of exit from hydrocarbons. As I mentioned, it is the combustion of the fossil fuel product that is really the main part of the life cycle emissions. So the combustion can be tied to about 85% of oil and gas life cycle emissions. And so as a result, under Paris-aligned pathways, there's limited space for new oil and gas projects. And so relevant stakeholders should be really focusing on whether companies have planned for new developments and production. And then beyond that, it's not necessarily so important on what the company transitions to, if anything. You could be following a strategy of returning cash to shareholders, or you could be transitioning into renewables. In either way, if you're exiting from hydrocarbons, that in itself is going to be reducing your climate impact. Next slide, please. And then in terms of the energy transition response plan, this should really be highlighting how the company is aiming to preserve value. So first, it should be looking at how the company is investing in its upstream business. So whether it's increasing production or decreasing production. And then second, how it's reallocating the cash that it historically would have been reinvesting into upstream production. So is it, solely returning cash to shareholders, or is it investing in new businesses, whether that's renewables, petrochemicals, etc. And so for this kind of risk response plan, different companies, it's not a one size fits all approach. So some companies, it may make sense to be diversifying into new businesses, while for other companies, they don't have a competitive advantage there. And so it may make more sense to simply return the cash to shareholders. Next slide, please. And so when we're thinking about assessing both transition risk and climate impact, there are a common set of metrics that can be used, and the focus can be on different dimensions. So for example, if we're thinking about a company's CapEx plans, from an energy transition and risk dimension, you could be looking at, what percentage of this oil and gas CapEx is going into new long duration projects that are not competitive, i.e. they're very costly compared to other peer projects. And in the long run, as demand for fossil fuels declines, will there actually be a sufficient market to buy that future production? Whereas on the climate impact side, you would be thinking, okay, under a Paris-aligned pathway, there of 1.5 degrees of warming, for example, there wouldn't be any room for new conventional projects, and therefore this CapEx into new conventional projects is incompatible with my goals as a financial institution. That's one example of a metric applying to the two different types of plans, but you can also look at emissions targets, executive remuneration, companies' long-term forecasts for commodity prices, the pace of the transition that they envision, etc. So I'd encourage you to check out our report for the full kind of description of metrics, which I won't drill into just for the sake of time. But all of these are complementary. So, I mentioned production and CapEx are kind of a main focus area, especially from a risk perspective. But you could think of emissions targets, for instance, as providing a proxy view of long-term production plans, since Scope 3 emissions are so heavily tied to production. And then executive remuneration similarly would, involve incentives to shift away from production. So those are just a few examples, and I do want to highlight our upcoming Paris-aligned 3 report, which provides a really good overview, tying together lots of different metrics into a comprehensive and comparative assessment of some of the biggest oil and gas companies, which my colleague Rich is leading on. Next slide, please. And so kind of what are the main takeaways for investors here? First, you really need to be clear on what type of corporate transition you're aiming for. Is this a climate impact goal that you have, or are you really trying to reduce risk and engage with companies tailoring your strategy to either climate impact or risk? You need to ensure that corporates are disclosing the appropriate metrics. So it's not just about, how much you're disclosing and disclosing everything under the board, but really, are you disclosing the sector-specific oil and gas metrics, for example, production plans, CapEx plans, commodity price forecasts, et cetera, that will allow for decision useful investment strategy. You need to focus on the substance of what's disclosed as well. So moving beyond whether companies are just disclosing, is the actual transition plan strong? So how does a company stack up against peers? Is it actually compatible with the investors' goals or kind of the fund's mandate, et cetera? And then once you have this information, you really need to be taking action accordingly, which I'll get to in the next slide, please. So in terms of engaging with oil and gas companies, this should really be a sector-specific approach. So I mentioned the transition risk aspect is relevant to all investors per their fiduciary duty. And what actions can you take on this front? So first, you can ensure that the rating agencies that you may be using to help inform your investment decisions actually incorporate this transition risk. Ensure that your investment consultants are basing their models off of accurate climate data. And for asset owners, ensure that you have the appropriate incentives in place for your asset managers to actually be executing on their investment mandate and acting on fiduciary duty. And then from a climate alignment perspective, really assess whether it's credible to remain invested in a company if you find through this assessment that is not aligned with your climate goals, whether it's a specific Paris alignment, warming level, or otherwise. And then additionally, we have found that the most effective engagement from a climate alignment perspective is the actions that also mitigate risk, because, especially in this regulatory environment, it can be a lot more justifiable to certain regulators, and it can also allow you to collaborate with other stakeholders that don't necessarily have a climate mandate, but who still, of course, have a stake in the risk aspect. And so that concludes our oil and gas transition plan presentation, but just want to, again, encourage you to put any questions you may have into the Q&A or otherwise download our reports, which are free and accessible on the Carbon Tracker website. And passing it back to Gabriella. Thanks very much.
Thank you so much, Olivia. That was an insightful presentation. I like also to highlight that we see corporate transition plans as key tools to help stakeholders assess climate-related financial risk and opportunities facing companies. For most stakeholders, whether government, bank, asset owner, corporate, the transition will be complex and will require a plan, and credible transition plans should reflect a level of ambition aligned with the Paris Agreement, include a forward-looking delivery and implementation strategy, be public, independently assessed, and regularly progress checked. But before we move to the second part of our session, I have a question for you, Olivia. In the context of weakening regulations in some jurisdictions, why are robust transition plans more important than ever for long-term sustainability and credibility?
Yeah, that's a great question, Gabriella, and one that we've definitely gotten in recent weeks. So I think I would highlight two dimensions. The first being the climate risk perspective, and then the second being climate impact. So first, in terms of climate risk, as I mentioned earlier on in the presentation, the biggest risk that we really see for oil and gas, for example, is substitution of demand for the product. So as cheap renewables are rolled out, as EVs gain headway, there's really risk of long-term declining revenues for oil and gas companies, regardless of short-term policy shifts. And at the end of the day, if the economics of a new oil and gas project is unfavorable or uncompetitive, then it isn't in the best interest of investors for that to be invested in, regardless of whether some regulations are now more lenient. So that's the risk angle. And then on the climate impact angle, I would just highlight that even if there are some jurisdictions where there has been a rollback in climate commitments, and some investors' commitments as well, there's still quite a few countries and a wide swath of investors, especially in Europe, where this climate mandate remains. And so oil and gas companies are ultimately producing a global commodity, and in order to sell into markets where regulations remain, or maintain strong relationships with investors who have this mandate, they do need to be addressing their climate impact as required.
Thank you, Olivia. So, and how then should investors and other stakeholders interpret recent rollbacks of planned investment in renewables or weakening of emissions targets by companies?
Yeah, I think a lot of times you'll see a big headline about a big oil and gas major starting to reduce investments in solar or wind, or kind of shifting back its emissions targets. And I think at the end of the day, you need to think about whether this ultimately changes their plans for production. As I mentioned, in terms of reducing the climate impact of a company, it's ultimately the main thing is reducing production of oil and gas. And so, maybe a company isn't now planning to invest into renewables, but it could be planning to provide that cash back into shareholders. And so the question of investment in renewables may kind of may miss the mark, or may not be the most important thing to focus on. You really should be looking at production. So that's on the investment in renewable side. I think on the emissions target side, you need to think about whether the change in the target is actually tying to an absolute reduction in emissions. So there are some companies that will change their emissions intensity target, and it looks like now it's less lenient or less stringent. And at the end of the day, this might not have any bearing on their absolute emissions levels, since intensity is ultimately, independent of absolute volume of oil and gas produced.
Thank you so much for your responses, Olivia. And now let's move on to the second part of our session, where we will discuss the methane blind spot, and we can come back with new questions and comments. I also see some comments and questions in the chat. So why methane matter, given its potency over 80 times more powerful than CO2 in trapping heat over a 20-year period? Methane reduction is seen as a critical near-term strategy in the fight against climate change. Simply, there is no pathway to climate goals without tackling methane emissions. I'm pleased to be joined by Richard Collett-White. Welcome, Rich. You joined Carbon Tracker in October 2023 as an analyst in the oil, gas, and mining team. Prior to this, you worked as an editor and reporter focusing on misinformation, greenwashing, and the influence of vested interest on climate and energy policy. You've published stories alongside outlets including The Times, The Guardian, and The Independent. Thank you so much for being here. Over to you.
Thanks very much for the introduction, Gabriella, and thanks everyone for joining. It's great to be with you all today and to discuss these topics. So, as mentioned, I'm going to be discussing the impact of methane emissions within the oil and gas sector, which is a work stream that we've been building out recently. And I'm going to be covering two publications in particular. Firstly, I'm going to be speaking about oil and gas methane targets and measurement, as we assessed in our latest absolute impact report at the end of last year. And then on the methane implications of gas-based carbon capture projects. So if we could have the next slide, please. And the next one after that, thank you. So just to give some, previous one. So just to give some background on our Absolute Impact Report series, if you're not familiar. So this report series assesses the emissions targets of the largest oil and gas companies, and this latest report looked at 30 companies, and we look at various factors. So we look at whether the targets are appropriately designed or framed. So do they link through to a finite global carbon budget? Are they covering all the business activities of the company? And then we look at their trends over time. Are they improving? Are they stalling? Are they regressing? And then how do they stack up against each other? And finally, we look at credibility. So is a company's strategy for how they will achieve their targets and deliver those emissions reductions, is that credible, or does it rely to some extent on some questionable approaches that may be kind of uncertain or potentially commercially unviable? So moving on to the next slide, please. And so this is just a quick overview of how the report series has evolved. We've been going for 5 years on this topic, and this latest one added two kind of key components. It added a number of wholly state-owned national oil companies to our company universe, and we also looked at the methane-specific targets that companies have been adopting, and that's what I'm going to be focusing on particularly today. Next slide, please. So as Gabriella said, there's a real kind of momentum around methane emissions at the moment. It's widely recognized that significant near-term methane reductions are needed to keep the Paris Agreement goals within reach, given its potency. And there have been a number of kind of international intergovernmental initiatives and industry initiatives in recent years. There's a Global Methane Pledge at COP26, the Oil and Gas Decarbonisation Charter at COP28, and there's growing regulatory action in a number of jurisdictions. We also wanted to look at methane, given its kind of viability as a climate solution. There's the economic and kind of technical viability of cutting methane emissions is very clear, and so that has kind of led to significant expectations from policymakers and kind of progressive investors and civil society to make progress on this topic, and we wanted to look at the methane specific targets as distinct from CO2 in order to kind of assess ambition on this issue distinctly, kind of disaggregated from CO2 rather than in an overall greenhouse gas emissions kind of lens, which is often how targets have been set in the past. So next slide, please. So in our Absolute Impact series, we have a number of hallmarks that we use to assess the Paris alignment of companies. I'm not going to go through the first few hallmarks, which relate to greenhouse gas emissions overall, but it's hallmark 4 that we've added this year, and that's specifically on methane emissions and consists of 3 different components. So we want to see companies setting methane emissions targets for near zero by 2030, and on a full equity share basis. across all upstream activities, but also if a company has midstream gas assets, their target should cover those as well. So moving on to the next slide, where we'll look at the results. So as you can see from that table on the right, there are significant gaps in methane targets currently. So the majority of oil and gas producers have coalesced around a near zero methane by 2030. But only one company, Chevron, currently has an equity-based target. So that includes its non-operated assets, not just its operated assets. And that really means that companies are overlooking a significant amount of their production. In many cases, that's particularly the case of European and US listed companies, which have stakes in non-operated assets through joint ventures, and that's happening in some cases in countries with very high methane emissions, such as Algeria and Nigeria, and those are not being covered by targets currently. And then it's also another finding was around the midstream gas assets. We're finding that companies are not setting targets covering those assets. So that's pipelines and LNG facilities that they may have on their books. And that's despite the contribution that these make to overall methane emissions. And finally, there's a kind of lack of standardization really around a lot of methane intensity targets in particular. So companies use a real kind of range of different numerators and denominators. So that makes it very difficult to kind of compare ambition across the board. And there's a reliance on kind of using gas as a denominator, and that kind of skews results. There are efforts underway to kind of fix that by the IEA and others, but it is a kind of persistent problem at the moment. And also the kind of term net near zero is defined very differently by different companies. So that's another kind of challenge. Next slide, please. And then, so we also wanted to look at companies' measurement of methane emissions, not just their targets, as a kind of indicator of credibility. And so looking at OGMP 2.0, I think if you click through, you'll some more text should appear. But OGMP 2.0, this is the kind of flagship initiative to kind of improve reporting and measurement of methane emissions. And so we looked at their assessments because essentially there's a lot of underreporting of methane emissions currently happening. And that's as a result of relying on emission factors rather than kind of direct measurement. And so OGMP is trying to address that problem. And there is significant progress going on. A growing number of companies are being assessed as on a gold standard pathway, or they're reporting at a gold standard level. And that's particularly the case for European and US producers, but also some national companies as well. And the gold standard pathway, that indicates a kind of credible strategy to directly measure methane emissions of all assets, both operated and non-operated. And when a company is assessed as being gold standard reporting, that indicates that they're reaching high levels of reporting credibility. But also it's important to recognize that doesn't mean that a company is directly measuring all assets at the highest level, which is level 5. So still kind of, a lot of room for improvement there. And so this all means that really until companies are directly measuring, their targets should be viewed with a certain amount of skepticism, and their disclosure should be viewed with a certain amount of skepticism. And then secondly, there's a point there on routine flaring, which gets a fair amount of attention, and that we see that as a kind of quite limited indicator of credibility. It's positive that so many companies are setting ambitious targets on that. but there are limitations with some of the targets because it's only focusing on routine flaring, and that can sometimes be quite a small proportion of total flaring. And also, venting is really a much bigger source of methane emissions than flaring. So it's important not to kind of place too much emphasis on zero routine flaring. Next slide, please. I'm now going to move on to talking about the methane implications of gas-based CCUS projects. So this is based on some research that Carbon Tracker has conducted in the past year, and looking at how carbon capture ties into methane. I'm going to be kind of looking at a particular case study. So next slide, please. So yeah, one of the kind of key findings of this research that we've been doing on CCUS is really the very significant methane footprint of CCUS projects which are being planned in the UK. So that means gas-fired power plants with CCS and blue hydrogen, particularly if they're being fed by liquefied natural gas, LNG imports. And so, as I said, I'm going to just touch on a case study which we've done recently. So next slide, please. So this is a Peterhead gas-fired power plant with CCS. It's a proposed gas-fired power plant in Scotland, CCS at Peterhead, and it's being co-developed by SSE and Equinor. It's currently awaiting planning permission by the Scottish Government. And the aim of the research was really to kind of assess the real emissions of the project, and kind of scrutinize the estimates that had been put forward in the official environmental impact assessment. So next slide, please. So we really identified three kind of oversights really in the official environmental impact assessment. And that first one is the kind of most relevant one here. The kind of key issue at play is that a lot of the gas feedstock for this plant would very likely be from imported liquefied natural gas, particularly from the US, and that's associated with very high methane emissions from the extraction process, and then also from the shipping process. And LNG imports are set to increase significantly as a result of domestic production declining in the North Sea. And so that's really a kind of example of how methane emissions can kind of change the emissions footprint significantly. And we kind of looked at various different scenarios with varying levels of LNG in the mix. And we can see on the next slide what that looks like in terms of the kind of life cycle emissions. And that increases them significantly. The red bar, that's the upstream emissions, and that's the biggest component, with methane being the kind of key issue there, and it does increase life cycle emissions significantly. It's also worth saying that this particular estimate is potentially quite conservative, because official estimates, as I was saying before, of methane emissions are being significantly underestimated. And so when you look at peer-reviewed studies, they show much higher emissions. So we've kind of taken averages or weighted averages from different estimates. And so it could actually be significantly higher. And secondly, it's also based on a what's called a global warming potential of 100, and that's when you average the impact across 100 years. If you're using a shorter time frame, for instance, the 25 years between now and 2050 net zero goals, the kind of CO2 equivalent emissions will again be much higher. Next slide, please. So finally, just to kind of round this off, there are multiple investor implications from the above publications. So obviously, methane emissions are crucial to a company's alignment with Paris Agreement goals and pathways. But it's also of relevance to all investors, regardless of whether they have a climate mandate or not. Methane exposes companies to a growing kind of regulatory regime around this issue. And then with regard to CCUS, it obviously has a bearing on the emissions footprint and profile of different projects which are being proposed. And then by extension, their overall kind of company climate alignment as well. Next slide, please. So thank you everyone for listening, and yeah, looking forward to the Q&A, and please do reach out if you have any further comments or questions. Thank you.
Thank you so much, Rich. I'd like also to highlight that the global scope of the methane reduction task is massive. Methane emissions from the fossil fuel industry present an especially promising and immediate opportunity for climate action. And capturing methane from fossil fuel exploration reduces leaks and explosion risk, thereby improving industrial safety. To kick off the Q&A session, I have a few questions. Rich, how do companies' methane targets compare with their efforts to cut CO2 emissions? What explains this difference? And also, your presentation highlighted problems with measurement. What role can investors play in pushing for better methane data from oil and gas firms?
Sure, thanks. Great questions. So firstly, on the kind of difference between methane targets and kind of overall CO2 or greenhouse gas emissions targets, you do find that methane targets are typically stronger. As I kind of said, companies are going for near zero methane, at least at their operated assets, and that's really, I think, because it's possible to kind of demethanize oil and gas production. There's the technical viability of methane reductions, but it's as Olivia said earlier, it is very difficult to decarbonize if you're including Scope 3 emissions, because that essentially means you need to reduce production. So that's why I think there's kind of some quite ambitious near-term, 2030, even 2025 targets by lots of companies. And then in terms of what investors can do to kind of advocate for better measurement practices, I think the key way is really through OGMP and encouraging companies to engage with the program and kind of move up the levels of kind of measurement accuracy and coverage of their assets, and kind of regularly monitor and use a range of different technologies. There are satellites, there are drones, there are optical gas imaging cameras at the site level. There's a kind of whole range of options, and I think also encouraging companies to engage with their joint venture partners, because that's really where there is huge potential to cut methane emissions at those sites.
On that, methane is short-lived in the atmosphere. So why are emission reductions necessary? Why is this so relevant?
Yeah, it's a good question. It does sometimes come up. People kind of, I think, sometimes assume that because it decomposes in the atmosphere, therefore methane emissions aren't really a problem. But the kind of short answer is because we keep adding to those emissions every year. If we just kind of cut methane emissions immediately, then that would have a huge impact on temperatures kind of immediately. But it's because we keep on adding to them. We keep on kind of replacing those methane emissions, which are kind of decomposing in the atmosphere.
Thank you so much. And one last question for you, Rich. What does the new US administration mean for action on methane emissions within the oil and gas sector?
Yeah, so I mean, obviously, there is a kind of significant rollback of regulations underway, particularly around the methane fee or the waste emissions charge as it's known officially. But I would say, lots of producers have already invested significantly in kind of methane monitoring and reduction efforts, and I don't think that they'll immediately go back. Lots of them have kind of vocally supported the regulations and kind of don't want them to be completely cut. They don't want this kind of cycle of swinging between very different kind of regulatory regimes around this, and particularly for LNG exporters who are obviously wanting to continue to access certain markets. Obviously, the EU with its methane regulation, but also other countries such as Japan and South Korea who are kind of bringing in methane measurement and performance standards. They're going to want to continue to access those markets, and then also I think there will be a certain amount of action at the state level. So, for instance, in New Mexico, I think they may still continue with the methane regulations that they have in place. So yeah, it's a kind of mixed picture, but a very interesting question.
Thank you so much. And there is a question in the chat for Olivia now. When you say transitioning away from oil and gas, it means that the company still has to transition its business to something else. This is the major issue for all oil and gas companies.
Yeah, so not sure I understand the full scope of the question, but I think in general, the main point that we're getting across is all companies should be thinking about how to transition away from oil and gas as the transition unfolds. But what they transition to could look very different depending on their comparative advantages, the geographies where they operate, where they're selling into. So it's not a one size fits all approach in terms of what they're transitioning to, whereas you can kind of take more of a standardized sentiment in terms of thinking, okay, all companies need to be thinking about how the energy system is transitioning away from fossil fuels. I think an important point on this is just not getting caught up in headlines about what companies are transitioning to. For example, there's a great question on BP thinking about how it was once thought of as a leader in potentially transitioning to renewables, and now it's shifting back on that. But you have to take a step back and think about whether that's actually their area of expertise, or whether there are other providers, for example, other solar and wind companies that are better equipped to be in that space. And this is important from a financial risk perspective in terms of thinking about the competitiveness, but also from a climate impact perspective, thinking about, okay, which firms are actually best positioned to scale up the renewables sector, and the oil and gas sector is only accounting for about 1% of clean energy investment. So yeah, I think at the end of the day, transitioning away from fossil fuels is a very important consideration for all producers, whereas transitioning to could look, very different depending on the context of the company.
Thank you, Olivia. And two more questions for you. How should one assess the use of negative emissions technologies such as CCUS in oil and gas transition plans? And why should oil and gas transition plans address Scope 3 emissions?
Yeah, so CCUS is always kind of the hot button topic. And I think you'll see a lot of talk about CCUS in oil and gas company transition plans, looking at how am I going to reach net zero by 2050? Oh, we'll just CCUS our way out of our emissions. But this kind of gets around the big picture, which is that the energy system is transitioning away from fossil fuels. And so CCUS doesn't insulate you from that reduction in demand. If there's declining demand for oil and gas, it doesn't matter if you're adding CCUS on top of that. There's just not going to be demand for your product. And I think the other really important point is thinking about the cost implications of this technology. So right now, it has not been proven financially viable at scale, especially at the level that you're seeing companies project in the long term. And so, you know, for every CCUS project that you're investing in, that is adding on costs to consumers. And you have to ask whether that cost will make your oil and gas product competitive on the global market. And then from a climate impact perspective, you need to think about whether that technology actually will be fully capturing the amount of carbon that you project for the long term. So a lot of CCUS projects are developed, implemented, and then actually it's found years later that a lot of the carbon that we think has been stored is actually leaking back into the atmosphere. And so it's kind of a wash from a climate perspective.
Thank you so much, Olivia. I think we also have a comment in the chat from an anonymous attendee. I think this one is for Rich. If you have any information on VAM project to reduce methane gas.
I'm afraid I don't know. Sorry.
Thank you. So I think with that, we've addressed all the questions. So thank you so much for all your responses and for the good questions. As now we are to the end of our session, I'd like to say a big thank you to Olivia and Rich for the excellent presentation and insights today. And thank you to everyone in the audience for joining us. Progress may not be as rapid as we need, but change is underway, and that brings new opportunities. A quick note, this session has been recorded and will be available on the Climate Bonds YouTube channel, along with the presentations. To access the related reports, please scan the QR code. Thank you again. And before we close, Olivia and Rich, do you have any final remarks? 1 minute each, please.
Picture takeaway for transition plans is that you really do need to take a sector-specific approach, but also kind of look beyond the branding of, oh, this framework assessment is, you know, produced by this organization, and think about whether that's actually a relevant metric for your investments, and move beyond disclosure. Actually start taking action. At the end of the day, whether you're trying to reduce risk within your own portfolio or looking to meet your own sustainability goals, it's not enough for companies just to be publishing information. You really need to be acting and transitioning. So I think go beyond words, take action. Don't be afraid to collaborate with other stakeholders who are moving ahead as well. Because at the end of the day, it's all every player has a role in the transition, and we all need to be working together.
Thank you so much. And Rich?
Yeah, I mean, I think on a similar theme, I think, yeah, you've got to look beyond the headlines, look beyond the kind of targets, and kind of dig into exactly what they're covering, and make sure that it's going to be delivering real world methane emissions reductions. And I think, yeah, looking at whether certain projects that sound like they're going to deliver zero emissions or big emissions reductions, such as CCUS projects, really are going to do so when you kind of look into the full kind of life cycle picture. So yeah, I think I would encourage investors to engage in the wide array of kind of international initiatives on this topic, and kind of help drive momentum on this issue, which really needs very near-term reductions. So yeah, thank you again for listening.
Thank you so much again for being with us today, and watch this space, and until next time.